Fundamental versus technical analysis. What every trader and investor must know. Welcome to MarketIQBasics. Today, we're covering two of the most important concepts in trading and investing: fundamental analysis and technical analysis. These are the two primary tools that traders and investors use to make decisions in the market. We're going to break both down in real detail, be completely honest about their limitations, and explain something that most beginner courses never tell you. Mastering either of these is a long, humbling journey that never truly ends. Let's get into it. What is fundamental analysis? Fundamental analysis is the study of the underlying value of an asset. For stocks, it means analyzing the financial health, business model, competitive position, and future prospects of a company. The goal is to determine whether a stock is overvalued, undervalued, or fairly priced, and make investment decisions accordingly. Fundamental analysts ask questions like, is this company profitable? Is its revenue growing year on year? How much debt does it carry? Who are its competitors and what is its position in the market? What are the broader economic conditions that could affect this business? Key tools of fundamental analysis. The first tool is the income statement. This shows a company's revenue, expenses, and profit over a period of time. A growing revenue with healthy profit margins is a positive sign. Declining revenue or shrinking margins can signal trouble. The second tool is the balance sheet. This shows what a company owns, its assets, and what it owes, its liabilities. A company with more assets than liabilities and manageable debt is generally in a stronger position. The third tool is the cash flow statement. Profit on paper doesn't always mean cash in the bank. The cash flow statement shows how much actual cash a company is generating. Strong, free cash flow is one of the most important indicators of a healthy business. The fourth tool is valuation ratios. These help you compare a company's price to its financial performance. The most widely used is the price-to-earnings ratio, or PE ratio. It tells you how much investors are paying for each pound or dollar of earnings. A high PE suggests investors expect strong future growth. A low PE may indicate the stock is undervalued, or that the market sees problems ahead. Other important ratios include the price-to-book ratio, the debt-to-equity ratio, and the return on equity. Each one gives you a different lens through which to view a company's health. The fifth tool is macroeconomic analysis. No company exists in isolation. Interest rates, inflation, employment data, GDP growth, and geopolitical events all affect stock prices. A fundamentally strong company can still see its stock price fall during a broad economic downturn. The limitations of fundamental analysis. Here's where we need to be completely honest. Fundamental analysis is powerful, but it is far from a perfect science. Two highly experienced analysts can look at the exact same company financials and reach completely opposite conclusions. Markets are forward-looking. They price in expectations, not just current realities. A company can have brilliant fundamentals and still see its stock price fall because the market had already priced in even higher expectations. Fundamental analysis also tells you very little about timing. You might correctly identify a company as undervalued, but the market might take months or years to agree with you. As the famous saying goes, the market can stay irrational longer than you can stay solvent. Mastering fundamental analysis takes years. Understanding financial statements, valuation models, and macroeconomic dynamics is a deep and complex discipline. Experienced fund managers with decades of expertise still get it wrong regularly. If you're a beginner, treat fundamental analysis as a compass, not a crystal ball. What is technical analysis? Technical analysis is the study of price and volume data, primarily through charts, to forecast future price movements. Unlike fundamental analysis, which asks what something is worth, technical analysis asks where the price is likely to go next, based on historical patterns and market behavior. Technical analysts believe that all known information, company fundamentals, economic data, market sentiment, is already reflected in the price. Therefore, studying the price itself is the most direct way to understand what the market is doing. Key tools of technical analysis. The first tool is trend analysis. Is the price making higher highs and higher lows an uptrend? Or lower highs and lower lows a downtrend? Identifying the trend is the foundation of technical analysis. As the old saying goes, the trend is your friend. The second tool is support and resistance. Support is a price level where buying interest has historically been strong enough to stop the price falling further. Resistance is a level where selling pressure has historically prevented the price from rising. These levels act as decision points for traders and are among the most reliable concepts in technical analysis. The third tool is candlestick patterns. Individual candles and combinations of candles can signal potential reversals or continuations in price. Patterns like the hammer, the engulfing candle, the doji, and the morning star are widely studied and used by traders around the world. But, and this is important, no candlestick pattern works all the time. They are probability tools, not guarantees. The fourth tool is moving averages. As we covered in our stock chart video, moving averages smooth out price data and help identify the overall trend. The 50-day and 200-day moving averages are watched closely by traders and institutions worldwide. When a shorter moving average crosses above a longer one, known as a golden cross, it can signal the start of an uptrend. The opposite, a death cross, can signal a downtrend. The fifth tool is momentum indicators. These measure the speed and strength of price movements. The Relative Strength Index, or RSI, is one of the most popular. It measures whether a market is overbought or oversold on a scale of 0 to 100. An RSI above 70 suggests overbought conditions. Below 30 suggests oversold. The MACD, Moving Average Convergence Divergence, is another widely used momentum indicator that helps identify trend changes and momentum shifts. The sixth tool is volume analysis. Volume confirms price movements. If a price breaks above a resistance level on high volume, it suggests strong conviction behind the move. A breakout on low volume is less reliable and more likely to fail. The limitations of technical analysis. Technical analysis is not a magic formula. It never has been and never will be. Charts show you what has happened. They do not guarantee what will happen next. Every pattern, every indicator, every signal is based on probability, not certainty. Markets are driven by human behavior, fear, greed, hope, and panic. These emotions are unpredictable. The same pattern that worked perfectly 20 times can fail on the 21st with no warning. Technical indicators are lagging by nature. They are calculated from past price data, which means they always tell you what has happened slightly after the fact. Furthermore, technical analysis is highly subjective. Show the same chart to 10 experienced traders and you may get 10 different interpretations. One trader sees a breakout. Another sees a false move. One draws their trend line at one angle. Another draws it differently. There is no single correct reading. Fundamental versus technical. Which is better? This is a debate that has gone on for decades in the financial world. The honest answer is neither is better. They are different tools for different purposes. Long-term investors tend to rely more heavily on fundamental analysis, buying great businesses at reasonable prices and holding them for years. Short-term traders tend to rely more on technical analysis, using charts and patterns to time entries and exits. Many of the most successful market participants use both. They use fundamental analysis to identify what to trade, finding strong companies or assets with solid backing, and they use technical analysis to determine when to trade, finding the right entry and exit points on the chart. The most important truth about both. Here is something that most courses and YouTube videos won't tell you, and we think it's the most important thing in this entire video. Neither fundamental nor technical analysis will ever give you a perfect answer. Ever. Not now, not after 5 years of study, not after 20 years of experience. The best traders and investors in the world are wrong regularly. What separates them from everyone else is not that they have a perfect system. It's that they manage their risk so well that their winners far outweigh their losers over time. Mastering either form of analysis is a lifelong process. Markets evolve, new patterns emerge, economic conditions change, strategies that worked in one decade stop working in the next. The traders and investors who succeed long-term are those who remain humble, keep learning, and never stop questioning their own assumptions. You will make mistakes. You will have losing trades and bad investments. Every single professional in this industry has. The goal is not perfection. It is consistency, discipline, and continuous improvement. Where should a beginner start? If you're a beginner investor with a long-term horizon, start with the basics of fundamental analysis. Learn how to read a simple income statement, understand what a PE ratio means, and focus on the overall health of a business before putting your money in. If you're learning to trade, start with the basics of technical analysis. Learn to identify trends, draw support and resistance levels, and understand one or two indicators well, rather than cluttering your charts with 10 different ones. In both cases, practice first. Use a paper trading account. Read widely. Study charts daily. Keep a journal. Be patient with yourself. There are no shortcuts. Final thoughts. Fundamental and technical analysis are the two pillars of market knowledge. Both are valuable. Both have limitations. Both require years of practice to develop real competence. Respect the process. Stay humble. And never let confidence in your analysis override your risk management rules, because no analysis, however thorough, removes the uncertainty of the market. At MarketIQBasics, our goal is to give you honest, practical knowledge, not false promises. The market is a long game. Play it wisely. If this video helped you, please like, subscribe, and share. Check the description for links to all our related videos. See you in the next one.